people working at the regulators, the golden parachute is to get a job in the banking industry and then get a pension and retire that way. So, and this is true not just in Canada; it's true in a lot of countries. The regulators become captive to the banking industry. The banking industry is so powerful and so strong, and unless they...
I got the honor of having Hilliard Macbeth with me. He's been an investment advisor for over 43 years. He's the author of 3 books on finance and bubbles. The latest is the 2nd edition, which is right here, When the Bubble Bursts. I highly recommend you read this book. I've actually read it twice, and it's quite fantastic because all the data points, all the different arguments that people rationalize about real estate are all in here, really. And specific to Canada, it's rare to find anything that is specific to Canada. But Hilliard's been on BNN, Bloomberg, CTV, and he's even written a book in the .com bubble, or about the .com bubble as well. So without further ado, I'm going to bring in Hilliard. Hilliard, welcome.
Nice to be on the show.
Yeah, thank you so much. So obviously your book, fantastic book. I've read it twice. And one of the things that, because obviously there's been some time that's passed since your book came out. And one of the things that you mention in the book, I really want to pull up with you, because I think you even tweeted this out the other day. And by the way, if you want to follow Hilliard on Twitter, it's actually in his StreamYard name right there, HMacB. So just go there. But Hyman Minsky, an economist who studied bubbles, it basically, you put in there about a euphoria state is a state that inevitably precedes a collapse in asset prices and a withdrawal of credit. And do you think that was what we saw in 2021? Was that kind of mad mania that you have at the end of a cycle?
Yeah, I do. I think we're close to the end of the cycle, although I have to say that I thought we were close to the end of the cycle in 2017 as well. So and shortly after the first edition of the book came out, the Toronto housing market took a downturn, and I thought, well, this is it, and of course that turned out to be wrong. And then 2020 came, and the of course with COVID the money dried up, and I thought, well, this is it for sure. and then the most amazing thing happened. The housing market took off again and added another 25%. So at least in some areas. But the thing that distinguishes the final stage of the Minsky, he calls it the instability hypothesis of finance. And just to back up just a bit, the economics, which is what I studied before I became a stockbroker. I was in graduate school in economics, but it was very academic. It's very theoretical models, and they're not very realistic. So they don't take into consideration things like debt bubbles or even banking, for that matter. They've got a very unrealistic set of assumptions that they use, which makes the math really interesting. And that's what they want you to do, is to do these very advanced mathematics thing, which I was fine with that. But when I asked questions, well, how does this work with the real world, they didn't want to talk about that. And I could see that, doing a master's and a PhD would have been difficult because it wouldn't have been allowed. So when I discovered Hyman Minsky, who was one of the economists that didn't get accepted into the mainstream, because he talked about things that didn't fit into that very theoretical model that's been around for 40 or 50 years. And what he said, he worked actually in finance. He worked, I forget which, one of the big firms like JP Morgan or Merrill Lynch or something for a while. Then he became an academic economist, but he wrote about the instability hypothesis. So his premise is the longer the debt level increases as a percentage of GDP, the more convinced people become that it's going to continue forever. And so they become more and more confident about the amount of money they can borrow. They become more and more confident about the return on the asset that they're buying, whether it be a business or whether it be a house or whatever. Bitcoin today, he didn't talk about Bitcoin. But whatever the thing is, whatever the borrowing is done, people become more and more confident about a positive rate of return after the interest rate that they're paying. And the instability hypothesis says that the more stable things are, for the longer the period lasts, the more more unstable things become. So we're in a very unstable phase, and that's because the amount of debt, both in the household and in the corporate sector, is at levels that have never been seen before. There's 3 or 4 countries in the world: Australia, China, a couple in Europe, small countries in Europe, and Canada is one of the biggest in that. About 220% of GDP is the corporate and household debt, and so that becomes a very unstable situation because, especially in Canada, a lot of that money has been borrowed to buy real estate, and real estate is not a very good earning asset. It's an asset that can pay you enough to pay the interest on the debt, but in a lot of cases, like when people buy houses for their own use, they don't get a return on that asset. They have to supplement it from their salary or their income, or maybe if they've inherited a lot of money, they're living off the dividends and the interest or whatever. But money has to come from someplace else to support that debt. So that's inherently a very unstable situation. And on the corporate side, well, about 50% of all corporate investment, believe it or not, is for real estate. So they build a factory. Well, first they have to buy the real estate that goes underneath the factory, right? So about 50% of that is going into now. Generally, the corporate sector would earn a return above the rate of interest, and so it would be less serious. But what happened in Japan in 1989 and in other countries, different times, is that the corporations started speculating with the money they borrowed. And in Japan, it was real estate that they started speculating in. And in this latest cycle in North America, a lot of the corporate borrowing has gone into buying back their own shares. So they because the share prices, as probably a lot of people know, are extremely high right now. We don't just have a housing bubble; we've also got a stock market bubble, which is really dangerous. They've been buying their own stock of their own company to support the stock price, and they justify it in 14 different ways, and I won't get into all the different ways they justify it. But the bottom line is they're paying a really high price for their stock, and it's they're going to wish at some point they didn't have all that debt associated with buying back their own shares. So that also makes it very unstable. So the 3 stages of finance are the first stage is kind of regular finance, which is well supported by the return on the assets. You can pay in the first stage, you can pay the interest and you can pay back the loan. In the second stage, called speculative finance of Hyman's model, you can only really pay the interest on the loan. You can't actually pay back the loan itself from the investment returns. And then in the final stage, which is called the Ponzi finance stage of Minsky cycle, they can't even pay the interest on the loan. And that's the stage we're in. And we've been in that stage probably since 2017, I would think, where people are borrowing from alternative lenders, they call them, at 20% interest. And they're using that to finance the loan. And the other thing they can do is they can flip the asset. If house prices are rising, they can flip it and get a bigger loan after they sell and buy another house. So it kind of gets obscured. The fact that they can't actually repay the loan out of the income that's coming from that asset is obscured. And people don't realize that they're borrowing for speculation. They think they're borrowing for investment, but the difference is if you have to sell the asset in order to pay off the interest on the loan and the loan itself, then you're speculating. If the return from the asset, say a business is paying dividends of 6% or something like that, then that's investment. But a lot of real estate investment doesn't pay nearly enough to pay the interest on the loan. People I've talked to, I can't tell you how many people I've talked to in the last 7 years since the first edition came out that own condos in Toronto and Vancouver and Edmonton and Calgary, and they're losing money every month on the rent after you pay the expenses, and the rents just aren't high enough, and the price of the purchase is too high. So So they're basically subsidizing it. And I say, well, why do you keep it then? I don't understand why you keep that investment if you're losing money every month. And the answer is, well, of course, when I sell it, I'll make such a big capital gain on the appreciation in the price of it that it'll cover all my losses that I've taken. So, and up until recently, with interest rates so low, the losses were only a few $100s a month. But now with these higher interest rates that are kicking in, and of course, people that own investment properties, they get treated differently when they go to borrow money. They pay a higher interest rate than the rate that people pay when they buy their owner occupied home. So they're paying a higher interest rate. It's going to 5-6% or whatever it's going to turn out to be, maybe 7. There's no way that those things aren't losing a lot of money every month. So then what will happen is they'll try to sell it in order to get out of that situation. And if even 10% of them or 15% of them decide that they want to sell that real estate speculation at the same time, it's going to be very difficult, because people will be surprised to know that only about 5% of the total real estate stock in the residential housing turns over every year. So if you try and up that from 5% to 10%, let's say, because a lot of people are trying to get out and pay down their debts or something, it's impossible. You can't. There just aren't. The buyers won't be there, and then the buyers will sense that something's happening. I think already it's happening in the housing market, that the buyers are sensing that something's changed, and they'll back away. And then it becomes even harder. Even the 5% turnover then becomes difficult without lowering the prices quite drastically. And then of course to add more sellers after that is just is not mathematically possible. So that's where the term, getting back to the Minsky model. So then Minsky didn't talk about this, but a guy in actually I think it was in 1999 or 2000, or maybe it was 2008. I'm not sure, but one of the finance people somewhere termed the crisis. I guess it was probably the global financial crisis. He called it a Minsky moment. A Minsky moment, when people realize that a whole bunch of people out there can't pay back their debts without selling their assets. That becomes a Minsky moment. And of course, then they all try to sell their assets at the same time. And the liquidity, real estate is inherently a really illiquid asset. So the liquidity is just not there. Even the stock market, sometimes you can't get, at least the stock market, you can do it within a couple of minutes if there's a buyer for your stock. But a house, you're talking days, weeks, even months to sell a house. And by then, a lot of things can change. Things are changing very rapidly right now. So that's the Minsky model. And I thought it made sense. And through that investigation into Minsky, I ran into a guy named Steve Keen. And some of your viewers might know Steve Keen as a prominent economist. And he's in the same category, what they call the sort of non-mainstream economists. And he's written a couple of books. One is Debunking Economics, and then one was Can We Avoid Another Financial Crisis? He's one of the very few people. There's 8 or 9 people in the world that were able to predict the financial crisis in 2008, 2009, with written evidence that they were calling it. And so he became fairly famous for that. And I got to meet him, spend some time with him, and it's really amazing. There's a whole bunch of people out there that are very serious about this whole thing and analyzing it from the point of view of a Minsky model rather than what the mainstream economics people do. And they've been way more accurate than the mainstream. The mainstream economists don't even recognize the existence of bubbles. I'd be surprised to know that the efficient markets hypothesis says that the bubbles basically can't happen because the markets are efficient. Well, there's nothing more inefficient than a bubble. When prices get so high that people are about to lose their shirt if the bubble bursts, that's very inefficient. So it's been quite the ride for about 7 years now, and it's possible that we may be at that point now where the debt bubble basically gets so large that it can't be supported any longer. We were probably there in 2020, but stepped in and transferred. They ran a deficit. The Canadian government ran a deficit of almost $400 billion. And almost that whole 400 billion went into the bank accounts of corporations and individual people. And so, of course, they didn't default on their loans, because why would they default when they have all that money, right? But now, 2 years later, they've gone through that money, or a lot of it. And it's interesting. I had a call from a guy in Toronto that was talking about it. I don't know how I met him, but anyway, I talked to him, and he said, yeah, so the small business people initially got a $40,000 loan under CEBA, I think it's called. The house, the ordinary citizen was CERB, and the business one was CEBA. And if you were a small proprietorship or small business, like a taxi driver, you got this this $40,000 loan, and then they upped it to $60,000. So this guy in Toronto told me that he was thinking about buying a townhouse in Scarborough with which was an $800,000 purchase. And the $40,000 was exactly 5%, which is what you need for a CMHC purchase, right? 95% loan. And he told me everybody was doing it. Like, he wasn't the only, everybody's doing it.
Wow.
And that's probably one of the things that gave us this last boost in the market that went crazy, right? But yeah, it's unfortunate. Like the reason, this book, I mean, why would an investment advisor write a book telling people that they don't want to know it? Almost all of my clients wanted their house to go up in value. They didn't want to hear that there was going to be a problem with real estate. And the reason I wrote it was that I could see that they were getting so wrapped up in real estate that it was going to really hurt their long-term investment programs. And after 40 years, you start feeling kind of responsible for these. I shouldn't have that feeling. I should just say, well, whatever happens, it's their problem. But some of these clients have been with me for 40 years. You go through the whole thing with them, right? And when you see them starting to change their attitude towards debt and real estate, and you just you don't want to be nagging them. It's not good for client. So I just thought, well, I better write this book and get these views out of my system rather than harassing my clients. See, you shouldn't be giving that money to your kids to buy a house. That's a big.
I was going to say that about that, because you mentioned that in your book about giving, because that's a big thing.
And when I wrote the book, it was like 100,000. Now it's like 300,000 or 400,000 that people are the parents, and the parents think they have 300,000 or 400,000 because they've got a couple of million in their retirement plan or something like that. But you take 300,000 or 400,000 out of those, a couple of million is in this day and age. I had an elderly relative that had to go into long-term care. She was needed complete care. And at the end, she passed away about a year ago, but at the end, she needed complete care. It was $11,000 a month, right? So like a couple of $1 million, $11,000 a month. You go through it pretty fast, right? So she had a pension from her work, and then she had some money. I sold her house for her. She had some money, but she was going through it pretty fast, and then she passed away. So there's a little bit left over, but she couldn't afford to live 10 years, not at $11,000 a month. And the worst part of it is all you get for $11,000 a month is a tiny little room, and people helping you. I mean, it's just a terrible situation. So people think they're rich enough to help their kids, but they may not be. Probably most people are not, even if they've got a couple $1 million saved up. It's if they've got 10 million saved up, probably but if they've there aren't that many people that have 10 million saved up outside of real estate. It's quite rare. So there's lots of people that have 1 or 2 or 3 million saved up, at least in my age bracket anyway. And but they still have to be careful. And then the worst thing of all is this co-signing the mortgage, right? So because in Canada, there's this thing called personal bankruptcy, and the terms are quite generous to the person that's declaring personal bankruptcy. So if somebody takes $50,000 from their parents, buys $1 million home with a $950,000 mortgage, and the house prices go down 40%, and it's worth $600,000, the parents can, just write off the $50,000. The kids can declare personal bankruptcy, and they get to start over again. And they have a bit of a black mark for a few years against their credit, but that's okay. They can easily, very quickly, buy another house with the help of the parents. But if the parents co-sign that mortgage, now the parents are on the hook for this ridiculous $950,000 mortgage. Even if the kids declare bankruptcy, it doesn't matter. Now the parents are still on the hook. and of course they can't declare bankruptcy because they've got more money. So they end up being responsible for the rest of their lives. It's just a terrible thing, and the banks were encouraging it because that way they didn't have to worry about it. Because most of these 30-year-old couples, they don't really qualify for a $950,000 loan. They don't have the income. There's quite a few households in Alberta that have two incomes that add up to 150 or 200,000. And I would argue even that isn't enough for a $950,000 loan. But apparently the formulas that the banks use are allow that. But in my book, I say it should be limited to 3 or 4 times income.
Yeah.
But they're allowing much more than that. They're allowing up to 6, 7, 8 times. It's crazy. But in most, like Toronto, the average household income is only 75,000. So I mean, it's a terrible thing. I can't believe that countries like Australia and Canada and a few other countries have gone all in on this residential real estate thing to the point of risking the financial stability of the whole society. But it happened. In England, every single bank in the global financial crisis went under. The government had to. They all became wards, except for one, an investment bank called Barclays, which doesn't do lending for home purchases. And even they cheated. They were underwater so badly, and so they gave a loan to I think it's Qatar, that Middle Eastern oil nation, and then Qatar took that money and invested. So the only way you can help a bank is to make an equity investment. You can't lend it money because that doesn't help their ratios. And so Qatar took that loan from Barclays for $5 billion or whatever, and they purchased $5 billion worth of shares in the bank, and that allowed the bank to escape the clutches of becoming managed, taken over by the government. And but then nobody knew that's how they got the money. And then when it turned out that it was discovered that they had done that, of course, it's illegal to lend somebody money to buy shares in the bank. So the same bank can't lend the money to buy the shares because it's self-dealing or something. So that case is still working its way through the court. So if you include that case, because they cheated, then every single bank in the United Kingdom became a ward of the government, and that's how bad it was. And so in Canada and Australia, it hasn't happened. And one of the interesting things about Canada and Australia is each country has 4 or 5 large banks that are concentrating most of the lending, so the government has been very helpful to them over the years in various ways, publicly and also behind the scenes privately. And so they're both known for having these very stable banking situations, but it's all backed up by the collateral is real estate. And if real estate were to crater, or if the bubble were to burst, then the banks in Canada and Australia would get into trouble, just like the ones in Spain and England, all over the world, just like those other banks did. So we'll see. But I just think it's a really dangerous situation that we've gotten ourselves into. And I don't personally feel responsible for it, but I think I will be quite angry if somebody in the government or in the banking system says, well, nobody can see that coming, like they
will.
I'm gonna spend $10,000 or $15,000. Maybe I could do one of those GoFundMe campaigns to take out a full page ad in the Globe and Mail and say, and call BS on that one. But and maybe that won't happen. I don't know. But certainly the rules. Now the banks did follow the rules. It's not that the banks broke the rules. The banks by and large followed the rules. But we got ourselves into this, and the few people that tried to warn about it were not listened to. So, but you could talk to somebody like Steve Keenan, and he'd say, well, exactly the same thing in Australia. He's from Australia originally. And,
okay.
And he's got exactly the same thing in Australia. And no government wants to be the one that presides over the bursting of the bubble and the arrival of the Minsky Moment, because no government can survive the next election after that happens, right? So that expression, kicking the can down the road, was like, we got some really good can kickers. We got the best can kickers in the world.
Yeah, that's true. And what do you think like about now? Because obviously, I think it's the OSFI or I get it muddled up there, whatever it's called, but the OFSI has come out and said that they're looking at reining in now all these leverage ratios of people who are over leveraged, and it's just like if they do that.
So OSFI is the regulator of the banks, and the problem with OSFI, of course, is that they are very small government operation, and the banks are very, very large, very powerful. You know, the banks make every 3 months, the banks make billions of dollars of profit. You know, the big banks, the two big ones, Royal and TD, probably make 10 billion profit a year. So when they go to meet with OSFI, you know, OSFI is supposed to be the regulator. OSFI is supposed to be telling the banks, well, no, I don't think you should be doing this because well, the bank shows up with a CEO that's making $10 million a year in bonuses and a couple of vice presidents that are making $5 million a year. And they walk in and they've got all these computer models and stuff. And the computer models say that it's safe what they're doing. They plug the growth in real estate prices into the model, and they plug the amount of debt into the model and the interest rate, and the model comes back and says, yeah, you guys are fine. You know, you're not taking too much risk. And the OSFI went so far as to say, the previous head of OSFI, put it in my book, I think, that he went so far as to say, you know what, we trust the banks to be able to calculate how much risk they're taking, if they're taking too much risk, because they've got the models, they've got the information, right? So
yeah, I remember that.
So the problem with that is, of course, that it's only based on the recent past, right? So that, like, some of us can remember what happened in the 1970s and 1980s, and it was, interest rates went up to 18-19%, and the banks all, without help, they would have all gone under, because people can't pay back their loans. So OSFI, yeah, unfortunately, and this is true not just in Canada, it's true in a lot of countries, the regulators become captive to the banking industry. The banking industry is so powerful and so strong, and unless they've had a crisis, like in England, in the United Kingdom, when all those banks became wards of the state, then the regulators had quite a bit of power over the banks, because the banks had screwed up so badly that regulators could say, well, you guys shouldn't have done that. Now we're going to tell you what to do. So for a while, so we're still in that phase, but that's now 12 or 13 years ago, right? So now I'm sure the banks are already starting to say, well, we think you regulators, you've been too, you guys are too worried about the risk. It's time to loosen up a little bit. And of course, the other thing they do is there's a lot of people that move back and forth between the banks and the regulators. They call it the revolving door, and the salaries at the regulator are like $300,000 a year maximum.
Right.
And, the salaries at the banks are much higher. So the people working at the regulators, the golden parachute is to get a job in the banking industry and then get a pension and retire that way. So it's a difficult. This whole regulatory capture thing is a problem worldwide, and that's definitely a problem in Canada. So yeah, I wouldn't expect that. They talk about reining stuff in and stuff, but when they actually have the meetings with the banks to say this is what we're thinking about doing, the banks will talk them out of it, I'm pretty sure. So.
Another thing I really wanted to chat, because you probably know more, well, you definitely know way more than I know about this, but is the 1990s real estate bubble in Canada. It's not often talked about, and it's not something that there's many details that I can even research on when you go and look, because obviously the internet wasn't really around back then. And what kind of caused that? Because it was a similar speculation madness, wasn't it, in Toronto?
Yeah, I mean, it's very different because first of all, the debt levels were much smaller. What caused that was interest rates went up to 13-14%. The interest rates had peaked in 1981 at 19%, but then towards the end of the 80s, there was another peak in the interest rates that went up to 13-14%.
Wow.
And that was too much for some of the speculators. And a big company called Olympia in New York, a big real estate company, very big, Canary Wharf and Wall Street some of the big towers in Wall Street, big towers in Toronto, big towers in Calgary. Actually, they own the successor to that Olympia, New York, is called Brookfield, and they're big. They own most of the assets that Olympia, New York owned before they went bankrupt, and that bankruptcy triggered a lot of things. So house prices went down about 35-40% in Toronto, but the bubble was tiny compared to what we have today. I mean, it's just I don't even know how to describe, you think of a mountain in Scotland, and then think of the Rocky Mountains west of Calgary. And that's the difference in the size between what was happening in 1990 and what's happening today. So the magnitude of things are just off the chart. Even the bubble in the U.S. in 2006, 2007, before it burst, and house prices went down 40%. It's a pretty small bubble compared to what we have today. The Canadian, Australia, and a few other countries, New Zealand, for some reason, the prices just kept going up and up, and they're way beyond the peak in 2006. To give you an idea, in 2006 in the U.S., the peak of investment in residential real estate was 6% of GDP, and it had never been that high. It peaked right around the time of the bubble bursting, 2006, and it went all the way down below 3%, and it's now recovered back to about 4 or 5%. Canada was at 6% at the same time in 2006, and at that time, the government of the day under Stephen Harper and the finance minister was Jim Flaherty, they introduced zero down payment for mortgages, so you had no money down and 40-year amortization. So basically, that means anybody with a job can buy a house. Right? So the payments are pretty small, and you don't have to have any down payments. So what happened was the investment in residential real estate in Canada went up to 8%, 7%, then 8%, and recently, just in the last couple of years, it's at 10% of GDP. And so the size of the bubble is just. And there's 220 cranes in Toronto active right now. There's 35 or so in Calgary, and this is like Toronto's the biggest by far. The second biggest city of number of cranes in North America is something like 50 or 60. I think it's Seattle or something. And Toronto's 3 times the second biggest one, and even Calgary. With that bubble, up until recently, there was a bursting of the oil and gas bubble in 2014. Mm-hmm. Even Calgary's got 35 cranes, which is it ranks about 5th in North America. So wow. So it's just impossible to describe how big this bubble is in Canada. I've tried in the book to describe it, but it's just really hard to. I guess the only thing that probably compares is Japan in 1989. That was a pretty big bubble, but none of the recent bubbles. Like the 1991 in Canada, or even the 2006 one in the U.S., they don't really compare. The current bubble is 2 or 3 times the size of any of those. The one in 1989 in Japan was pretty enormous. So the government kept pushing the banks to lend money, and the business people, almost all the lending in those days was not to households, it was to corporations in Japan. And these corporations, they didn't have any projects. The bank would say, we want you to take another billion yen or whatever. Okay, well, they didn't really have any choice. They had to take it, right? And but instead of putting it into their business, they had no projects in their business it was an economic miracle from 1945 to 1989, 44 years. The top car manufacturers, all these top consumer electronics companies, the Panasonics and all that, it was all built from nothing in 40 years. But at the end, what happened was the government kept telling the banks to lend to these people, and these people had to take the loans, and they didn't have anything to do with money. So what did they do? They bought real estate, right? So the real estate prices in Japan got ridiculously high because it was all based on borrowed money. And, it bottomed in about 25 or 30 years later. It was a 25 or 30 year bear market in real estate in Japan. And I think now it sort of seems to be turning the corner, but we're now
still struggling. We're
now 30 years, right? So the last 5 years or so, it hasn't gone up particularly, but it's not going down anymore. Let's put it that way. So.
That's it. That's crazy, really, when you think about how long that's been. Do you think also that the currency, because you mention it in the book, you briefly kind of touch on it about when Home Capital Group did get rescued in the end by Berkshire Hathaway and everything like that, and the currency slump that occurred. It's hard to predict these things because you don't know how markets are going to react, but if the Canadian banking system had a crisis, obviously that's going to translate into the currency to a certain degree. And now we see that the currency kind of doesn't trade coupled to anything. Like it used to trade on oil, like it doesn't really trade on that. I've tried to see if it trades with the stock market, and it doesn't seem to trade with that either. So, like, do you think the currency is sort of a risk point that if it does go down, the central bank's going to be in a corner where they can't cut rates by a substantial amount because the currency is losing so much value? Do you think that could be an issue?
Well, what's happened is the U.S. dollar has gotten really strong in the last couple of years because people are, the war in Ukraine and other things that, and Canada's actually, our Canadian currencies slipped a bit against the US dollar, but it's only at 77 cents or 76.5 cents. So it's only a slippage of about 3 or 4 percentage points. So Canada still has a AAA credit rating in most rankings. There's only a couple other countries larger than Canada in the world. Germany is one of them that still have a AAA credit rating. So the world is generally not aware of the instability of the Canadian situation with real estate. The fame of my book hasn't spread wide enough yet to convince people. And even if they did see it, they wouldn't be convinced. So because Canada has this reputation as kind of a conservative banking segment with a very safe haven kind of a thing. So it would require a pretty big crisis. But, you mentioned home capital. When that thing blew up in 2017, it was, the currency was slipping pretty badly. And because it looked like home capital would go under when the fraud in the mortgage brokers was discovered. Home capital shares went down to almost to nothing. And I'll remember it for the rest of my life when that announcement came out that Warren Buffett was going to rescue home capital. Like, what? It's like it made no sense. Like it's like $1 billion deal, $2 billion. It's like Warren Buffett said many times that the deals. It's a $700 billion company. They've got $170 billion in cash. Absolutely no benefit to them to do $1 billion or $2 billion deal. So it was just like I don't know. Apparently somebody from the Bank of Montreal, retired, knew Warren Buffett, called him up and said, there's a crisis with this major non-bank lender in Toronto. Can you help? And he agreed to help for some reason. If it hadn't been for that help, I think that it would have caused a mini crisis. I don't think it wouldn't have been big enough to cause a major crisis because it wouldn't have affected the banks that much, But if there's a real estate bubble bursting and it does affect the banks, then that's when you see the currency get into trouble. That would be the trigger. Not a home capital, but something bigger like one of the banks in Canada. And that may or may not happen. Certainly, it's going to be difficult for people that have lent a lot of money against residential real estate, and the banks are the biggest in that category. But they do have a minimum capital requirement that they meet, and they're actually in excess of that. So I think what you'll see is that they'll survive. I have a whole chapter in there. It says the banks will survive. They won't thrive though, because they'll be dealing with bad debts for a number of years after the bubble bursts. So that's anybody that's involved in residential real estate or lending to residential real estate. I can't make specific recommendations on specific stocks on this channel, but I would say move your money away from that area because it's going to struggle. The people involved are going to struggle. The businesses are going to struggle. The investments are going to struggle. It's going to be and it's not going to be a one-year thing. It's going to be the U.S. where the peak was in 2006. The bottom was in 2010. So ours is quite a bit bigger, but it'll be at least 4 years from peak to trough. And so that gives you lots of time to go elsewhere and then come back. So
yeah. That's true. And there's so much of a gap between like the trend for real estate in places like Toronto and where prices are at now. The declines could be like 50% plus, which is just, I think you even mentioned in the book about real estate correcting to the trend, and usually it goes beyond the trend, and it's just such a long way down for some of these markets.
Yeah, you'd have to say that real estate's been growing roughly at 7% per annum for 20 years, so that's a fourfold increase. And if you look at the inflation rate, or a good proxy would be after-tax wages and salaries, and those things haven't doubled, right? They're between 150. If you start everything at 100, we have a chart that we use every month. People can see it if they want to look it up. on Twitter. It'll come out next week. It'll be we update it every month. So the proxies for inflation and wages and that sort of thing, CPI and all that, they haven't doubled. They're like 150 to 200, and the average house in Canada is 400. So to get back to the trend line, which is what people like Jerry McGrantham say has to happen when the bubble bursts, would require that house prices to come down to the 200 level or a little bit lower. But sometimes it overshoots, as you just said, that it might even go lower than that. So that's a pretty big hit. Although a 50% decline from these prices, still the average house in Toronto is still going to be 500,000, which is still much higher than it was in 2001 or 2002. So it's like, I'm sure people will complain, but baby boomers that are, they bought their house at 300,000 and now it's worth 500,000, they shouldn't really complain because they got a gain, just not anything like the gain that they thought they had. So, and of course, they will get into trouble if they created a HELOC and borrowed the money to give to their kids for them to buy houses, because now the family is long 3 or 4 houses, all of the based on the collateral of the residential real estate that the parents had initially, right? So it's an amazing thing,
Well, thank you so much for coming on. Just fantastic to speak to you, and maybe we can do this again some other time as well.
Yeah, I'd like that. It's wonderful. Yeah, it's a good format, and it's too bad we didn't get to answer any questions from the group, but we can do that next time.
All right, Hilliard, thank you very much.
Thank you.
All right, take care. Thank you guys for all tuning in. I'm sure we'll do another stream at some point